A very good morning to all of you. On behalf of Committee on Public and Government Financial Management of ICAI, I welcome you all to the third session of Virtual Conclave on Introduction to Cash Basis IPSAS Path Towards Accounting Reforms that is being organized by the committee under the theme Azadi Ka Amrit Mahotsav. Today's virtual conclave will throw light on cash basis IPSAS, which serves as a sound starting point for public sector entities that do not have any accounting standards in place to strengthen their financial reporting practices. Compliance with the cash basis IPSAS supports public sector entities to enhance their accountability with regard to cash receipts, cash payments, and cash balances at the reporting date. Today we are having with us CA Prasanna Kumar D, Vice Chairperson, Committee on Public and Government Financial Management, and CA Anand Jain, former Chairman, Indore branch of ICAI, as moderator of today's program. Today's session will be taken by CA Ashok Rao. Viewers can ask their queries in the chat box. ICAI members can claim 2 hours unstructured CPRs after the conclusion of the program. Now I would like to invite CA Anand Jain, moderator of today's program. CA Anand Jain is a fellow member of ICAI. Besides this, he is a law and commerce graduate. He has completed certificate courses on forensic audit, concurrent audit, and audit of cooperatives organized by ICAI. He is serving in Indore branch since last 13 years and had been the youngest elected managing committee member. He has served as chairman of Indore branch 22-23 and also taken responsibility of serving as SICASA chairman 2016, secretary 2017, and CP chairman 2018 of Indore branch. Being a proud practicing chartered accountant, his area of practice includes RERA, government audit, internal audit, consultancy to real estate developers. He also appears before Appellate Authority of RERA and GST. I welcome you, sir. Now I hand over the platform to CA Anand Jain.
Thank you, madam. So on behalf of the Institute of Chartered Accountants of India, I welcome you all to this third virtual conclave on Introduction to Cash Basis International Public Sector Accounting Standards, Path Towards Accounting Reforms. The series of virtual conclave on recent accounting reforms in the government is being organized by the Committee on the Public and Government Financial Management under the Azadi Ka Amrit Mahotsav. I heartily welcome the Vice Chairperson of the committee, CA Prasanna Kumar Sir, to this conclave. I also welcome our guest speaker, who is an eminent expert in the public financial management and government accounting arena, CA Ashok Rao ji. So moving to the theme of this conference, the Cash Basis International Public Sector Accounting Standards is a principle-based fair presentation cash basis accounting framework that has been developed by the board IPSAS. The cash basis IPSAS sets out the requirements that are applicable to the public sector entities preparing general purpose financial statements under the cash basis of accounting. Cash basis IPSAS also prescribes the encouraged disclosure that the public sector entities may adopt to enhance the usefulness of its financial statements for the accountability and decision-making purpose and to support its transition to the accrual basis of accounting and later on adoption of the accrual IPSAS. I hope the viewers will be benefited from the deliberation of this virtual conclave. I once again heartily welcome all the viewers to this conclave. So moving further, we are privileged to have the Vice Chairman of the committee, C. Prasanna Kumar Sir, amongst us. Before inviting him for his welcome remarks, I would like to give a brief introduction of the Vice Chairman of the committee, Prasanna Kumar Sir. He is a Bachelor of Zoology from Loyola College, Chennai, and MA from Sri Venkateshwara University, Tirupati. He has become the member of the institute in 1984. He has been occupying several positions in the affairs of the institute right from SICASA, branch, regional, and central council. During his student days in the CA course, he was the secretary and vice chairman of the Southern Indian Chartered Accountants Student Association, Chennai, and in the early 80s, he made significant contribution to the students' fraternity. He served in Visakhapatnam branch as treasurer, secretary, vice chairman, and chairman of the branch during the year 1998 to 2002. He was the member of SICASA and Southern India Regional Council from the year 2007 to 2016. He was the chairman of the Regional Council in 2013 and 14, and he has been elected as the Central Council member for the period 2019 to 22 and 22 to 25. He spoke in many seminars and conferences organized by the ICAI on bank audit, company law, ethical standards, industrial policies, and budget analysis. He is a keen follower of the sports and himself being a volleyball player. He has also held numerous positions in the sports field. With this, I request the Honorable Vice Chairman of the committee to please give his welcome address. Over to you, sir.
Yeah, thank you, Mr. Anand Jain. Respected CA Kemisha Soniji, the chairperson of the Committee for Public and Government Financial Management, and CA Anand Jain, the former chairman of indoor branch of CS of ICI, and the speaker for today, CA Ashok Rao, and other participants in the webinar. Good morning to all of you. I have great pleasure to welcome you for today's seminar, because we, as all of you are aware, that we started a series of seminars called as recent accounting reform in government. We told in the first, when the inaugural conclave was conducted a month ago, that the importance of the entire thing, particularly keeping in view the accounting standards and also requirements of the government, and later technological developments, and later requirements of the stakeholders and the regulators, keeping all this in view, we thought it fit that not only the chartered accountants, even the officials who are governing the entire financial management of the government should also be involved. This is one particular series where, so the government officials are also participating. In this series, there's a third in the series, third conclave we're having it. The topic chosen is very good topic. Like Anand Jain has already introduced this topic. So the topic is very, very important by keeping with the IPSAS for the cash-based system. As you're aware, you may be thinking, where is the cash system of accounting? This is the old history. Only in history and geography we read this one. It is not in vogue anywhere. But given the situation of the government, they are spending, they've got a lot of internal control mechanisms, everything is there in government, but the accounting is missing. That is the reason why, if you take the Panchayat institutions, so they are not subject to audit. The issue is they don't have the proper accounting, though they got internal control mechanism and spending. So keeping in view that, to start with, we have to go with the cash system is a simple way of accounting the accounting mechanism. Slowly, this should be taken as first step towards converging the entire accounting system to the accrual system accounting in future. So today we have a eminent speaker, Ashok Rao. If you have to talk about who will be able to speak about the government financial management or the accounting reforms, there are only some 5-6 names come in the entire country, probably not exceeding 10. And Ashok Rao is one amongst them. Anyway, there will be proper introduction to him. He's a very good speaker, and we've got a good moderator today, Anand Jain. And the entire scheme has been developed by our chairperson, Kemisha Soniji, who is the entire, this particular committee is very close to our heart. That's why the Honorable President has nominated her for a consecutive second year also. And we are taking a lot of measures here in the committee, in the CPGFM, to see that whatever we are targeted in the beginning of the year will be achieved under the dynamic leadership of our leader, Kemisha Soniji. With these words, I once again welcome you for this particular conclave. I'm damn sure the end of this session at 1 o'clock, you'll be having a lot of knowledge, lot of value addition. Wish you all the best. Thank you very much.
Thank you, sir. You have rightly mentioned that when we talk about the speaker on the public financial management, none other than Mr. Ashok Rao can be a better person to speak. So let's introduce our speaker of the session. C. Ashok has close to 25 years of work experience. He specializes in PFM program design, implementation, PFM diagnostic studies, setting up accounting, budgeting, financial reporting systems in the government, conceptualizing and implementing e-governance initiative and their assessment, process re-engineering and trainings. C. Ashok has worked extensively on financial reforms in urban as well as rural local bodies. He has exposure to the policy, process, people, and technology aspects of the financial reforms. He has extensively worked in the state of Tamil Nadu, Karnataka, Himachal Pradesh, and Orissa. He has published articles on various PFM topics in different publications, including newspapers and journals. His article titled Commitment Control, a step towards or beyond accrual accounting appeared on IMF's PFM blog. C. Ashok has been a part of the ICI Committee on Public and Government Financial Management and also hold an additional certificate of PFM by ICAI. So we are fortunate to have you, sir, today with us. I request to please enlighten all our viewers and give the guidance for how we can transit into the accrual accounting system. What is the status of adoption of cash basis IPSAS in the government, and what is the Indian and government global perspectives, and how the challenges we are facing, what are the challenges and how we can overcome all the challenges in adoption of the cash basis IPSAS. So over to you, sir, for your deliberation. Thank you.
Thank you, Ananjan ji, and a very good morning to all the participants who have joined us. And thank you, Vice Chairman, sir, and from the committee, Shivani, thank you for organizing this. Today's lecture is special from multiple perspectives. Probably one of the first few sessions as we are celebrating 75 years of the profession. So first of all, best wishes to all our colleagues as we are doing that. And today also happens to be Guru Purnima. So let us wish ourselves all the best as we are embarking upon this knowledge sharing exercise. Of course, the topic is not a very exciting one, I would say. Talking about accounting standards on a Monday morning, and that too the first working day of the week is not a very popular one. But between me and PA Anand, we will try to make it as interesting as possible. Of course, I'll first go through a presentation. We'll discuss a few things, and then we'll take up the questions, which I'm sure as a moderator, you'll keep him busy trying to compile the questions and then put them to me, and we'll make it as interactive as possible. So I have a PPT. Let me just share my screen. So I suppose my screen is visible?
Yes, it's visible. Yes.
Okay, great. So another reason also this topic is very important, like CA Prasannaji just mentioned, is that it's so many years or more than we're in the 8th decade after independence. Probably the achievements that India has made on the corporate finance side, maybe not yet on the public finance side. So there is a lot more yet to be done. Of course, a lot of action we are seeing in the past decade and a half with the central government, the state governments, local bodies coming onto the bandwagon. The finance commissions also raising this point in every report. The need for better accounting systems, financial reporting systems, the need for better transparency and fiscal management. And of course, in the institute doing its part, the committee particularly, first in bringing out the accounting standards for local bodies, which are based on IPSAS, as we will see as we go along. Plus also reaching out to state governments, both center as well as states, and trying to spread this idea of better fiscal management powered by accounting reforms. So we are at the right point discussing this. Today's session, what I'll try to do is, the idea is not to go through the standard in detail, because I'm sure people can read it up. Whoever is interested can always take the standard and read it and see what it says. But to understand the context for this standard, of course, key features of the standard, what it tries to mandate and what it tries to encourage, as well as some challenges and some pointers for implementing this. Since I'm sure in today's audience, we have both members of the CA practice as well as people from outside the practice from within the government. I'll try to strike a balance between the technical and the implementation aspects. And anything, if it is too technical or something, please post a question, and CA Anandji will anyway pose it to me, and we can have a good discussion around that. So let us get into it right away. So first is what we'll try to cover today is, broadly we'll just see what are IPSAS, We've been talking about it, but there might be some people in the audience who might not know what IPSAS is about. So we'll quickly enlighten them. We'll talk about cash basis IPSAS, and very rightly the question of why a cash basis IPSAS. We'll look at some of the highlights of this cash basis IPSAS standard, and there are some global examples which are available. So we'll have a quick look at them as well, and have a discussion around the implementation challenges, as well as the way forward. Whereas participants, I mean, your inputs also will be very useful, since many of you have practiced accounting reforms in the field. It will be useful to understand the challenges and the way forward. So to start off with, first the context, of course, is the IPSAS. So IPSAS stands for International Public Sector Accounting Standards. So as the name suggests, this is an international set of standards. These are applicable to the public sector or the government. Of course, the public sector, the common way we understand it, in India at least, we also use public sector for saying public sector units for the government businesses. But it is very clear that government businesses, these standards will not apply. For the public sector units, like we know them, for the government companies, there the normal commercial accounting standards will apply, which is Ind AS in the Indian context. But when we talk of government, it covers the central government, the state government, and the local governments, which is the urban local bodies, as well as the Panchayat Raj institutions. Plus, it also extends to a whole host of quasi-government bodies. Like it could be your boards, or it could be the corporations, it could be various authorities. Maybe you take a SEBI, or you take a NFRA, or you take a development authority, or a pollution control board. These are all quasi-government authorities, which kind of form the government sector as a whole. So it would apply to them as well. So the IPSAS are promulgated by the IPSAS board, which is an independent standard setting board. We could say it's an arm of the International Federation of Accountants. So they bring out the standard. But of course, to make it mandatory or not is within the jurisdiction of the respective governments. So if you look at why is IPSAS different? Why not we adopt the normal standards? Yes, the principles of IPSAS are broadly based upon the International Financial Reporting Standards, which in India we call it the Ind AS, the modified form of the IFRS. We follow the Ind AS, which is brought out by the ICAI. So you might understand that it is not a rule-based, these are not rule-based standards, but more of principle-based standards on the lines of IFRS or Ind AS. And of course, all this is international, but if you ask me what is happening in India on this, in India, the ICAI has worked with the government in bringing out accounting standards for local bodies. It is a complete set of standards which are inspired by IPSAS, but with the necessary tweaks and carve-outs, as we call it, to suit Indian conditions. So these standards are available on the institute website, the committee website. You can have a look at it. Not yet mandatory as such, not yet notified by the government as mandatory. But on the field, you see that a lot of state governments are already adopting it as they are moving from cash basis to accrual basis accounting. For example, a couple of years back, we worked with the Commissioner of Municipal Administration in Tamil Nadu. So in the terms of reference, it was very clear that the new accounting manual that will be developed has to also include elements of the accounting standards for local bodies issued by the ICAI. Plus 2 accounting standards, the institute has also made it mandatory on the members of the institute as they perform their certification of financial statements of urban local bodies. So it will be useful for you to get a feel of the standards, go through it, and then understand it. So this is the current status in India. As of now, it is only for local bodies, but there is some talk of central government as well as state governments adopting it, but not much action as of now. We will come to that. It's covered in a separate slide. So next, the question which the Vice Chairman rightly raised when he was giving his address is that all along we are talking of transition to accrual. We have to move from cash basis to accrual system. We need to have standards, procedures, software to do that and all that. But suddenly today we are talking of cash basis system, cash basis accounting. So why are we doing that? Why are we talking about it? All the more for members of the institute for whom accrual accounting is a kind of it is a given. There is no negotiation about that. But then today we are going to talk about cash basis IPSAS. Let's see why it is required. First and foremost, I think internationally as well as within country, we recognize that this transition to accrual within government particularly is a long drawn affair. It is long drawn, it is complex, and there are several complications which you don't see in a normal commercial accounting scenario. So it is going to take time. Many of you might have worked with governments actually. You know how difficult it is to first create the policy changes, then have an opening balance sheet in place, then to train the entire set of government personnel, more specifically accountants, on the accrual accounting. And it only happens in stages. The initial few financial statements will have some drawback, but over period they mature. Then you also have somebody who can audit these financial statements. So it is a journey, it is not a one-time exercise. But then we can't wait for one final day where everything is going to be set. We can just put a switch on and then we can say accrual accounting is live. It is a process. As an intermediate goal to accrual transition, it was felt that the cash basis accounting itself in the current form, there are so many improvements that can be made, a lot of standardization that can be built in, which will improve their readability and credibility, as well as help them in the accrual transition. So as an intermediate goal, it is required. Second is for better credibility, to lend better credibility to cash-based financial statements. Because in the absence of standards, what happens? Each entity will prepare it in its own way. Each person within an entity might prepare financial statements in its own way. It will still be called receipts and payment statement. It cannot be called anything else. But the way it is presented, the way information is shown, the disclosures could all be very, very different depending on who is doing it. So having a standard lends a bit of credibility, bit of standardization. And more importantly, when you need to compare two entities who are producing their financial statements, so the comparability is much easier when the statements are in accordance with some standard. Even though they are cash-based statements, but still they have a lot of useful information, lot of analytical information, which for using has to be comparable to compare performance across organizations. So both from this perspective, a standard was felt required. In fact, probably the confusion was so much that if you look at the IPSAS, the cash-based IPSAS doesn't have a number, because it is very, very clear that we don't want to give it a number and make it a permanent standard. It is just to facilitate the transition or for entities which continue on cash basis, and that's why it doesn't have a number as well. So what is the cash basis IPSAS? So it deals with financial reporting under the cash basis of accounting. So cash basis of accounting, most of you might realize, but let me just repeat, is accounting happens only when there is a movement of cash. Either there's a receipt or there is a payment. Whereas we know that a lot of financial transactions occur where there need not necessarily be a movement of cash. For example, when you raise a tax demand, for example, let us take the case of a municipality. A municipality raises a tax demand on an SSE. There is no entry passed in the books. It is recorded in a register called Demand Collection Balance Register, but there is no entry in the books under the cash basis of accounting. On the other side, the accrual basis of accounting would recognize the income from the tax, would also recognize that this much is receivable, would also recognize it when the money actually comes in. So compared to accrual basis, cash basis would record it only when the money is actually received. So basically, when there is a receipt or a payment. So this standard covers that basis of accounting, the cash basis of accounting. It is a separate standard for entities that are on cash basis. There is no mix-up between these and the accrual standards. Like I told you, there are 43 accrual-based accounting IPSAS, but there is only a single standard which is on cash basis accounting. So it was published long back in 2003, and it has been amended from time to time based on implementation experience. And the latest revision applicable is since January 2019. Though the standard says 2017, I think that was when the amendment happened, but the applicability is since January 2019. So for example, if you now ask, is there a scope at all for implementing the standard? Because there is a lot of talk of accrual. We know a lot of entities have moved to accrual. Other entities are talking of moving to accrual. Then why is it we bring one more standard for cash basis, and then people start getting comfortable with cash basis, and then we say now move to accrual? Is it not going to create confusion on the ground? Which is a very valid question. But if you look at the data, it suggests that 70% of the governments, I'm talking of a national government, are still not on accrual basis accounting worldwide. But having said that, by 2025, 50% of jurisdictions will report on accrual because they clearly, there is a clear intention statement of intent saying that we want to move to accrual. And by 2025, it is expected that half of the government will be reporting on accrual. This is published in a study by the International Public Sector Financial Accountability Index, that is called the 2021 status report. So which means there is a case, we have a lot of entities on cash basis. We also know many of them are transiting to accrual. So positioning this cash basis standard now will be very useful for them to standardize, get used to standards, and also start transitioning to accrual. So this is pretty much what I was talking in terms of numbers. If you see 30 plus 40%, about 70% are still on cash, or even you can say partial accrual, but not fully on accrual, including India, which is on cash basis. This is of course a map from directly from the report, and you can see how the distribution is, just for you to get a visual idea of it. So moving on, what are the benefits of moving? Is the benefit justified enough to undertake that pain of implementing the standard? Yes, we would say the benefit is accurate, credible cash-based financial statement, which I was anyway mentioning to you. Better transparency and accountability, because rather than just putting out a receipts and payment statement, if a government says we have prepared a R&P statement in line with the standard, definitely, and put it out on public domain, it is definitely more transparent. Plus, there is also a lot of information that the standard requires, which automatically ensures better accountability. Third point is, yes, it's an intermediate step to transition to accrual. We've spoken about it. It also builds confidence among stakeholders, because a lot of the questions they might have in mind, instead of them asking and again getting information, a lot of that information would already be available in the cash-based financial statements when it is prepared in line with the standard. Next, better predictability of cash flows, which is one important thing that people look for when you look for cash-based statements, saying whether the organization is able to sustain in future, because there is no visibility into assets and liabilities, complete visibility into assets and liabilities in a cash-based statement, I would say. So predictability of cash flows is something they will be looking for. So this helps reach that decision. And more importantly, it is simple to implement, so people can get used to it. As we'll see later, the information the standard is asking is not very complicated, and it is definitely a good beginning in the transition to accrual. So with this background, let us now get into the cash-based IPSAS and see what are the requirements broadly. So this section we will look at the cash-based IPSAS, the requirements, which is in part 1, part 2, as we will see later. And then towards the end of the session, we will look at the way forward and then some challenges and pointers for implementation, and then maybe take up the questions accordingly. So what is the objective of this standard? So the objective is to prescribe the manner in which general purpose financial statements are to be presented under the cash basis of accounting. Cash basis of accounting, we all understand, we have discussed now, but we are also talking of general purpose financial statements, which is a bit tricky. What is it in a cash basis accounting scenario? Accrual basis, we know it is very clear. It's the statement of assets and liabilities, the balance sheet, the income statement, and the notes forming part of it, plus a few other statements. But what is it in a cash basis system? These are all prescribed in the standard, and we will look at it. So if you look at the information sought by users of cash-based accounting, it is basically they would like to have information on cash receipts, cash payments, and cash balance of an entity. When the assessment of an entity's ability to generate adequate cash in the future, which somebody looking at accrual statement, it comes intuitively. You can look at the short-term assets that they have, which can be quickly converted to cash. But this is some specific information that you have to look for in a cash-based financial statements. Predictability of the cash flows, likely sources as well as users of cash. Not only the sources, the users also, as to where the money will come from and where the money will go. And of course, related, it is again related to predictability, is the timing and certainty of the cash receipts and cash payments. So the standard is also driven towards enabling users of financial statements in answering these questions, or in getting information on these points. So what is the standard about? I am now talking of the physical standard that is there, the document. It is in two parts, part 1 and 2. Part 1 is a mandatory portion of the standard. So it is about 50 pages long, and it is applicable to all government entities preparing general purpose financial statements on cash, which is a repetition of the objective. But it is just to say that if an organization says we have prepared our general purpose financial statements in alignment with the cash-based IPSAS, it is reasonable to expect that it should conform largely to part 1 of the standard, which is a mandatory portion. Part 2 is called encouraged additional disclosures, which is not mandatory. As you can understand from the word itself, it is encouraged additional disclosure. That is again another 60 pages. So altogether, it is not a very small standard, but it is not a very complex standard either. So these are the additional disclosures that entities are encouraged to make. You can either disclose certain sections of it, depending on where you stand, or you can disclose all the requirements of part 2. So today we will try to largely discuss part 1 because discussing both the parts might be a bit too much. It might require too much time. Plus, it might also get a bit too technical. So we will not get into that. So look at part 1, the mandatory portion. We start with the definition of cash basis of accounting, which is what we just discussed, that accounting happens only when there is a movement of cash. It discusses requirements for disclosure of information in financial statements and supporting notes. So if you observe the nuance of this, it is not talking of recognition or measurement, because recognition as well as measurement aspects are very, very minimal in a cash-based system. It is mostly talking of presentation and disclosure. I would say largely, I mean, almost the entire standard is about presentation and disclosure, and not so much about recognition and measurement. Although when it comes to foreign exchange flows, it is also talking of what should be the rate applied to convert it into cash, into local currency and all that. but largely it is about presentation and disclosure. And it is taking up certain specific reporting issues. It's not a very wide standard, although it is principle based, but it talks of specific reporting issues and then discusses how it needs to be presented and disclosed. Part 2 is not mandatory, as I told you, additional accounting policies and disclosures. And the objective of part 2 is enhance the usefulness of financial statements. Not so much about standardization, but more to enhance the usefulness of financial statements, and of course to support the transition to accrual. If you see, a lot of the things are what we would expect in an accrual-based financial statement, but here it is in the form of encouraged additional disclosures. So applicability. So to whom is it applicable? It is applicable to entities which prepare an entity which prepares and presents financial statements under the cash basis of accounting, and it is applicable to general purpose financial statements. So which is basically a statement of receipts and payments, cash receipts and payments to be more specific, accounting policies, as well as the accompanying explanatory notes. So what does part 1 cover broadly? It, of course, on the basis of accounting, the definition itself, the presentation and disclosure requirements, some general considerations, which when we get to that slide, you will see are very, very small. I mean, it seems very obvious to see that anyway, this much will be done. Why would we need to put it in a standard? But you will also appreciate that it is required to put in a standard because different people might do it in different ways. So general considerations are there. Correction of errors, it talks about it. It talks about foreign currency conversion to local currency amounts. And very, very important, it talks of presentation of budget information in financial statements. Most of you who have worked with government would realize that the budget is a very, very important document in government. I would say it is the financial expression of the government's policy intent. So unless a government puts money in its budget, only then we know that it is serious about implementing something. Otherwise, not all policy intentions translate to implementation. But the budget is a very important indicator of what the government is going to do. It is also a very important tool of financial control within government, which is absolutely necessary. Of course, Appendix 1 deals with certain illustrations. The illustrative presentation and disclosure is also given within the standard itself. Part 2 covers a lot of other things. Of course, some definitions. The concept of going concern comes here. A concept of administered transactions executed by the entity on behalf of other entities. Then disclosure of major classes of cash flows over and above what is already disclosed under part 1, related party disclosures, then disclosure of assets, liabilities, revenues, and expenses. All these 4, in cash-based accounting are not fully accounted for. Partly, yes, certain assets are covered, cash assets are covered, certain liabilities also might get covered, revenues, receipts are covered, but not necessarily revenues, payments are covered, but not necessarily all expenses, and comparison with the budget itself. Consolidated financial statements, where there are controlled entities of the reporting entity. Joint arrangements are possible, so how to report in those scenarios is discussed. Then financial reporting in hyperinflationary economies, which at least we in India may not worry about it right now, because where money is going to lose value so quickly, how the reporting has to happen in a high inflation environment, that is covered. Payments by third parties on behalf of the entity is also covered, which would not appear in a typical receipts and payments account, but still it is made on behalf of the entity by third parties. So how to disclose that is covered. Then recipients of external and other assistance, the kind of disclosures they need to make is covered. And of course, the transition to accrual basis and adoption of accrual IPSAS, the pathway to that is also discussed with necessary appendices with illustration. So now let us spend some time on general purpose financial statements. It's a very wide term, but let us try to understand what it means in a cash-based scenario. So basically, the GPFS consists of information on sources of cash, purposes of usage, as well as the cash balances, both opening as well as closing. So what does it contain? It contains, number one, a statement of cash receipts and payments, which we could call a cash flow statement, we could call a receipts and payments account, but basically it's a statement of cash receipts and cash payments. Accounting policies and explanatory notes, which provide further information about the items in the statement of cash receipts and payments. And of course, a comparison of budget and actual amounts. This is also very important. So these are the main statements when we say general purpose financial statements. If any of you is advising your clients on implementing this standard, these are the three primary statements that must be prepared. It's a very important slide. So let us look at statement of cash receipts and payments. What are the requirements there? Yes, it should present total cash receipts along with subclassification, total cash payments along with the subclassification, and beginning and closing cash balances. Very, very obvious items. I mean, again, the question comes, why prescribe this in a standard? Is it required? But you would see many entities which will be missing one or more of this. Particularly when it comes to beginning and closing cash balances, it will most likely they might omit the beginning cash balances, the opening cash balances, or cash payments are stated, but there is no proper subclassification. A lot of such permutations, combinations are possible on the ground. So then the question comes, what subclassification? What do we mean by subclassification? There is some flexibility. So it says subclassification basis appropriate to the entity's operation. And it is a matter of professional judgment, which would be more useful for users of financial statements. For example, should the subclassification be by nature of expenses? For example, administrative expenses, personal expenses, repairs, maintenance, other expenses, depreciation. Sorry, depreciation doesn't come in a statement of cash receipts and payments, but loan repayments, interest payments, and all that. This is classification by economic nature. Or should it be by function? For example, towards central schemes, state schemes, local body schemes, or by function, for example, towards solid waste management, street lighting, in the case of an urban local body, I'm saying, infrastructure works, roads maintenance, employee expenses, this kind of classification. So which classification best suits the users of the financial statement? You'll have to adopt that, and more importantly, adopt it consistently from year to year. And cash receipts and payments are to be reported on a gross basis. This is very important. Let me give an example. A lot of entities get grants from the government. Let's take a municipality, small municipality, which gets grants from the state government. Many times, the dues of the municipality to the electricity authority, maybe for street lighting or for office building, that is directly deducted by the state government, and only the net amount is passed on. Suppose a 10 crore grant is to be received, and the municipality has about 1 crore dues to the electricity authority. So that would be deducted at source, and 9 crores only would be passed on. And what happens? Since 9 crore has come to the bank account, accounting will be only for the 9 crores. But the standard is very clear that it has to be on a gross basis. It has to be 10 crores of grant and 1 crore of expenditure adjustment, which needs to be shown. There is an exception to this. Net basis accounting is allowed in some cases where the transactions which the entity administers on behalf of other entities, for example, trust accounts, it is handling the PF trust accounts of the employees. There you can do a net basis accounting. There is no point inflating the receipts as well as payment side to show the net payments. Also, where the items, the turnover is very quick, amounts are large and maturities are short. Example again, when a local body collects some fees on behalf of the Road Transport Authority. Suppose it says every day you collect and next day it is to be remitted. So you are just doing a collection function. In that case, you need not account the gross. You can just account the net receipts of payments so that your closing balance reflects that. Then, of course, you might even have to go to a line item level receipts and payments to be presented if at all it is necessary. So these are the broad requirements of statement of cash receipts and payments. Second statement is on accounting policies and explanatory notes. So what do we need there? It should clearly explain the basis of preparation of financial statements, that whether it is cash basis or modified accrual or part accrual basis. Of course, accrual anyway doesn't come into this standard. Specific accounting policies for significant transactions. How are grants accounted? At what point of receipt are they accounted? More importantly, now we are going into what is called as a treasury single account structure. You might have observed in many cases, there is this PFMS system that is implemented, Public Finance Management System of the Government of India, where the grant, even though the grant is given to the implementing agency, the grant gets released only when payments have to be made. That is, the money is still lying in PFMS. Only when the payment is made, it is an entry is passed. Then in those cases, what is the point at which the grant income has to be recognized? Should be very clear. And similar, so many such challenges are there, which has to be very clear in the accounting policies. Then, of course, additional information that is relevant, because line item, chart of accounts and numbers can only speak that much. But there might be many cases where you need to give some additional information that has to be anyway given in the policy and explanatory notes. Then there has to be a clear cross-referencing between a note and the main item in the statement of cash receipts and payments. Otherwise, you can't just have notes which are hanging loose. It should be cross-referenced somewhere in the financial statement. You can even call it a schedule number or a note number, but the cross-referencing is very important. And any encouraged disclosures that are covered in part 2 of the standard, if you're making those disclosures, that should also form part of the accounting policies and explanatory notes. It should form part of this statement. So third important statement is the comparison of budget and actual amounts. So it should present a comparison of budget amounts and the actual amounts, and how it should be presented. So two options are there here. Either it is presented as a separate additional financial statement, or it could even be presented as additional budget columns in the statement of cash receipts and payments. So whatever you are comfortable with, you can do, because there is also a requirement that in the statement of cash receipts and payment, the previous year figures also have to be shown. So if you feel it is too cumbersome to show budget information as well as previous year information and budget information for that also in the same statement, you could present it as a separate additional financial statement. So what are the details that are required to be presented? Original and revised budget amounts. For somebody who is very new to government finances, in governments there is a system of first original budget, which is released at the beginning or even before the beginning of the financial year. Then maybe towards November, December, based on how actually spending has happened or revenues are collected, a revised budget is presented. It is more attuned to the realities that have happened during the year. So it is important to present both the original as well as revised budget amounts and actual amounts, of course. Actual amounts must be on a comparable basis. You have to use the same line items that you use for the budget so that it can be compared. And an explanation of material differences by way of note fixtures. So any material differences from the budget, what we typically call budget variances, have to be disclosed along with a reason for why the material difference came about. Some more information with regard to the same statement, comparison of budget and actual. Second bullet point is the presentation. When it is comparable, how it should be presented. If it is not comparable, how it should be presented or described. Which says that if it is not comparable directly, you have to have a reconciliation statement. The level of aggregation, that is at what level you are going to sum it up, is very important. Is it economic classification or functional classification, which I just discussed? Economic is by nature of revenue and expenditure. Functional is by the functions of the entity. Then changes from original budget and final or revised budget that we just discussed. And where there are multi-year budgets are prepared. Some entities, government entities, prepare a multi-year budget. It is called a multi-year fiscal plan or multi-year expenditure plan. Some disclosures are required there. That is also mentioned in the standard. Then, by way of note, please disclose on the classification basis. Same thing, economic, functional, that I just discussed. Budget basis also. Because in many cases, sometimes you might see that it could be that accounts is on accrual, budgeting is on cash. Sometimes budget is on accrual, accounting is on cash, or budget is a mix of accrual and cash basis. Whatever is the basis, it has to be disclosed. And what are the entities covered in the budget? Is it only the core government, or does it cover some entities outside the core government, quasi-government entities? And of course, the period covered, which in our case is mostly a financial year. But if it is something other than the financial year, then that needs to be covered. Next is a reconciliation when budget and financial statements are not comparable. Suppose your receipts and payments statement and your budget statement are on a different type of presentation for whatever reason. In that case, you will have to do a reconciliation between the two and see how that amount shown in the statement of cash receipts payments matches with the budget amounts as well. So this is a disclosure requirement, but ideally implementation guidance would be not to have a separate basis because it makes things complicated. But if you decide to have, then a reconciliation is required. Now there are some general considerations which we can quickly discuss. I was telling you these are the nuts and bolts of the presentation and disclosure. As you will see, first one, it should be present. GPFS, general purpose financial statements, should be presented at least annually. And if you are not presenting it for annual, then a longer or a shorter period, then you have to disclose why it is being presented for a longer or shorter period. Somebody might ask, where is this case? Why are we discussing this? But this is what the standard says. For example, some entities created during the year. So their first year reporting might not be for a full financial year. So in that case, disclosure should be required. Timeliness. So should issue financial statements within 6 months of the reporting date. This is a standard requirement. And encouragement is to do it at least within 3 months. Then it should also very clearly specify who is the authority and by when it is approved for issue. It should also provide some information about the entity, domicile and legal form. Legal form is very important. Something could be a trust, some other could be a board, some other could be an authority set up under an act, a state, central or state act. Something could be a local body, an elected body. So it is very important to mention that. Then the nature of operation and what are the principal activities. Then reference to the relevant legislation, name of the controlling entity and ultimate controlling entity. If it has to report to certain entities above, and if it comes under, obviously it would come under some department and ministry. So all these need to be mentioned, which is all very obvious. Most of the things on this slide are obvious, but it is also obvious that many financial statements might leave these things out. So it is important to have these. Then of course, disclosure in notes, restrictions on cash balances and access to borrowings. This is very, very important. If there are significant cash balances not available for use. So what do I mean? Or if there are external restrictions, what do I mean? So what I mean is particularly when there are escrow arrangements. Typically, banks lend to government institutions or local bodies, and they set up what they call as an escrow arrangement, where they say, suppose, let's take the case of Bangalore City Corporation, where I am from. Suppose there are 198 wards in the city. A bank might say, out of this 25 wards revenue, the property tax from these 25 wards, you will put up in an escrow account, which will be used for the loan repayment. So such balances are not available for use by the Bangalore City Corporation until the loan is repaid. So any such cases, if there are restrictions, it has to be disclosed. Also, undrawn borrowing facilities, which have sanctioned but you have not drawn. So it is a kind of a quasi cash balance that you have, which can be utilized at any time. So that also has to be disclosed. See, because if you recollect, this all links back to the predictability and timing and certainty of cash flows. These are all information which help you arrive at, you in the sense as a user of the statement, it helps you arrive at that decision. Next is, of course, consistency of presentation and classification, which all accountants realize is very, very important. Otherwise, the statement is as good as useless. It has to be consistent. Any significant change in the nature of operations, if it is because of that you are making a change in presentation classification, then please disclose it. Or if there is a change in the standard, or there is a change in the law, or a different system of classification is better, the entity feels it is better to present it that way, the underlying reason has to be disclosed. Then, of course, comparative information for the previous period in respect of all numerical, not only financial information. So any kind of numbers, if you are giving some quantitative information, not necessarily amounts, the comparative information for the previous year should be presented. Then, of course, when presentation or classification is amended, comparative amounts also need to be reclassified, which many entities don't do, but it is a requirement of the standard. And if at all, for some reason, the entity decides not to reclassify the previous year amounts, then the reason for the same also needs to be disclosed. And financial statement should be clearly identified and distinguished from other information. It shouldn't be called by some other name, and then we don't even realize that the statement has been presented. You can't call explanatory notes as notes from the board or notes from the commissioner or something, and then bring all information there, and still say we are compliant with the standard. That will not do. It has to be clearly labeled, named, and presented. And of course, additional information that is required. I wouldn't say additional, but basic information is, of course, the name of the entity, whether it's a separate entity or part of or a larger entity, it is controlled by another entity, reporting date and period, currency, and the level of precision. This is so important. It's such a small matter, but it is so important. Somebody presents in thousands, somebody presents in lakhs, a larger entity would present in crores. So it is very, very important to mention the level of precision that you are using, as well as the level of rounding of the number of decimal places that you adopt. These are all very important to mention. And of course, how the foreign currency conversion has been done for cash receipts, payments, as well as balances. There are a whole set of points which are covering that in the standard. I'll not get into that, but you apply the standard and then also disclose how you have converted the foreign currency amounts, if at all applicable. Then, of course, so these were broadly part one of the standard, what we discussed until now. Of course, I have tried to oversimplify it for the sake of today's discussion, because there is no point going into too much technical details, but people can always read up and understand it better. There is also very good resources on the IPSAS website, IPSAS board website, ipsasb.org. There is a lot of e-learning material. There are presentations, learner material, training of trainers material is also available. So you can go through that and make yourself well versed with that. So if you move on to part 2, which is about additional disclosures. If you remember, I told you that part 2, part of the objective of part 2 is to support the transition to accrual. So what is the information normally left out in cash-based financial statements? Receivables and payables are left out. Borrowings and other liabilities are not fully shown. Non-cash assets are totally out of the statement. Accrued revenues and expenses are not shown. Commitments and contingent liabilities are not shown. And performance information is also might be there, might not be there. Now I know by putting up this slide, I'll have some cash basis supporters saying, no, you can't say this is not there, it is all there in government accounts. But my only limited point is that it is definitely available in government, it is definitely available in the statements prepared. But when we talk of general purpose financial statements, which is the receipts and payments and the budget variance and the notes, these items are completely left out or partly left out, and they don't form part of the accounts, which when you compare to accrual system, the system of accounting itself makes sure that all these are captured and presented. For example, you can't have a balance sheet without showing receivables and payables, without showing borrowings and other liabilities. And non-cash assets or fixed assets, in simple terms, is a very important component of the balance sheet. So the system of accounting itself ensures that the final output of accounting covers all this information. And I mean, most of us who have worked with government, we know that a receivable typically you should have a DCB for that. But how many places do you actually see an updated DCB? And how many times the auditors talk about a DCB not being updated? We are aware. So the purpose of part 2 of this standard is to encourage entities to report on all these aspects, which also sets them up for accrual accounting. So what are the additional disclosures? First is, of course, an entity's ability to continue as a going concern. Very simple terms, going concern means whether the entity would continue to exist in its present form in the next financial year, or are there sufficient threats that the entity might not continue. So that is a going concern concept, which is a very important concept from accrual accounting perspective. Next is information on administered transactions. It could be tax collections on behalf of other entities. It could be pass-through cash flows. For example, the horticulture department might want the local body to collect fees for saplings sold, because they know the local body has officers, bill collectors across the city. It is a much easier collection mechanism for them to route it to local bodies. Similarly, transport department might collect some cesses along with property taxes, which is actually collected by the local body. So many such pass-through cash flows could be there. The health department might want to give out money to beneficiaries for maybe a COVID-like scenario, but they don't have the network to do it, but a local body has the network, so they will pass it through the local body. So many such things you can think of. Transfer payments, this is more very relevant at the state government level, where a lot of the central grants first come to the state government and then they're passed on as is to the local body, maybe 15 finance commission grants. So such transfer payments, if they are there, although they are strictly don't form part of the receipts and payments of the state government, they are only pass-through payments. These need to be disclosed if they are not going to be part of the main statement. Next is major classes of cash flows by nature and function. We have already discussed this. Then related party disclosures, which is very important from a corporate perspective, but from a government perspective also it might be important that if you are transacting with entities who are in some way related to the governing body or the institution, then it has to be disclosed separately. There's nothing wrong in transacting, but the disclosures are important. Then information on assets, liabilities, revenues and expenses. Information about service achievements. So what are the indicators of performance and how the entity has performed on those indicators is important. And then this is a very good move that was done in the most recent amendment to the standard, that many items which were earlier under mandatory disclosure, Part 1, were moved to Part 2 and made as encouraged disclosure, because there was feedback from the field saying it is being difficult to report this. First is consolidated financial statements. So earlier it was mandatory, now it is an encouraged disclosure. What we mean by consolidated is that if a board has set up a sub-entity, or a local body has set up a board or an authority which is under its control, so the transactions or the financial reports of the controlled entity also become part of the main urban local body. You can see this more in public-private partnership arrangements, where the local body might partner with a private partner and set up a institution or a SPV, special purpose vehicle. So the transactions of the special purpose vehicle are almost controlled by the local body, and the statements have to be consolidated. Similarly, payment by third parties on behalf of the entity, many times it is very difficult to track this information. It will be there available, but it will be in different places. Sometimes the account people might not even be aware of such transactions. So this was proving to be a big challenge, but now it is moved to encourage disclosures. And recipient of external assistance, including in-kind assistance. So many times you might get assistance in kind. To meet a flood situation, you might be getting blankets and medicines from as external assistance, which normally in a cash flow statement never appears, but it is also put as a encouraged additional disclosure. So these are some of the things that disclosure is encouraged. Then, of course, if you look at these were basically, I have not covered too much into Part 2, because these are encouraged disclosures, and then you have to first implement Part 1 to move on to Part 2. But the good thing is that the standard, if you look at it, in page 41, it provides 3 illustrations pertaining to Part 1. And in page 84, it provides illustrations of encouraged additional disclosures in Part 2, which are very, very informative. It is in, of course, an international setup, but it is not very difficult to understand it and also imagine how you would do it in a Indian scenario. For anybody who has worked with government, it must be pretty easy to understand that how the same thing will appear in our case, whether it is the union government, state government, or the local bodies that are involved. So these illustrations we can go through. I'm not getting into the illustrations right now. So my last part of the discussion is on, we looked at the objective of the IPSAS, why the IPSAS is there. We also looked at key features of the IPSAS and what it requires us to do. And seems to be a pretty well prepared standard. All the key requirements are already there. Now the point is the way forward. How does someone go about implementing it? What are the challenges, and what are the pointers for the way forward? We can discuss this and then get into the question answers. So let us first look at the challenges of implementing. And when I'm saying challenges, let us now localize our mindset to how challenging it would be in an Indian scenario. Maybe if you're talking of the state government or a local body or a quasi-governmental body, let us see what could be the challenges. First is, of course, a low capacity environment. I mean, due to various reasons, many of which are historical, we still have so many account functions in government entities which are not manned by accountants. For example, we work with local bodies a lot in the past several years. Whenever we go, we get to know that, for example, let's take the case of municipality again. In the health department, we have 20 doctors. Education department, we have so many teachers. Engineering department, there are so many engineers. But when you come to an accounts department, there is a veterinarian, there is a medical officer sitting there preparing accounts, or a basic data entry operator who is preparing accounts. So capacities is a challenge, Forget accrual accounting, even for cash-based accounting, it is a challenge which can be overcome, and a lot of good action is happening here. Many states have amended their rules to recruit accountants only with BCom qualification, and that they have to go through some level of training before they can be placed on the in the role of an accountant or an accounts officer. And there is also a lot of training. The institute is also very active in this training and sensitizing the people across the country. But it continues to remain a challenge, and for them to understand how it's to be done. Second is, of course, the mandate question. If you look at the accounting in the country at different levels, the Controller General of Accounts does the accounts of the Union Government. The accounts and entitlement wing of the C&AG's office, Controller and Accountant General Office, does the accounting. He is the compiler of accounts for state governments. And at the local bodies, you have the accountants, basically the accounts officer, the chief accounts officer, and below them the accountants who do accounting in local bodies. It could be urban local bodies, ULB, for whom accrual accounting is mandatory, or it could be rural local bodies where cash basis of accounting is followed. Even in quasi-governmental institutions, it is basically the finance officer and accounts officer and then the accountants who do the accounting. So just imagine the wide range of stakeholders involved, which makes it quite a challenge to implement a common standard. Also, on top of this, if you look at the union and the state government, the standards for cash system of accounting are set by an entity called the Government Accounting Standards Advisory Board. It's a government entity, of course, manned by people from the Indian Audit and Account Service. They are also mandated bringing accrual accounting standards, which are called Indian Government Financial Reporting Standards. As of now, there are no IGFRS in place, but there are a few IGAS which have been issued. But that is GASAB is the standard setting body, which means a very important stakeholder in this entire thing. And the other challenge is, of course, that certain provisions of the standards are genuinely difficult when it comes to consolidation, third-party payments, external assistance, etc. Not so much difficult to understand what needs to be done, but difficult to implement it on the ground. Getting data and then preparing the statements is all very difficult, because many times the information would lie outside the entity or outside the purview of the accounts department per se, which is when it becomes a bit challenging to implement this standard. Yeah, like I was just saying, information could lie in different records and systems, because most entities which are on cash basis would be on a manual system of accounts and record keeping also, unfortunately. Because one good thing which is happening in the country is, as entities are transitioning to accrual accounting, they are also using this opportunity to computerize the entire process, digitalize the entire process, which makes it a lot more easier to collect and compile information. But this is not the case in traditional cash-based accounting. It would lie in different record systems, many times not updated, not up to date, or it could lie in different departments. So data gathering, compiling, verifying the data is also quite difficult to meet the requirements of this standard. So these are some broad challenges. None of them are such that they cannot be overcome. But then this gives a sense of what we are up against. But then what are the pointers for implementation? What can be done? Because if you keep discussing of challenges, then there is no way to move forward. But what could actually be done, let us see, is there is definitely a scope to review the existing formats of presentation and disclosures to bring them in line with the cash-based IPSAS. Basically, government accounts, if you look at a broad level, they are called as finance accounts, one set of accounts, and appropriation accounts, another set of accounts. Very a high level of approximation, I would say, is finance accounts is more like the receipts and payments. Appropriation accounts is more like a summary of the ledger. For typical accountants, I am explaining. So there is a scope for looking at them and seeing how they conform to IPSAS, to what extent they conform, and to what extent they don't conform, and what can be done to introduce them. Some exercise has been done. There are a whole set of statements that are prepared as part of the annual accounts of state and union, which contain a lot of this information in different places. So there's nothing wrong in presenting it that way. But then if you want to align to this standard, then it has to come into these three statements, and it has to consider some of the general considerations that I was mentioning. Those need to be also factored in. And this is definitely a scope for taking up. Panchayat Raj institutions, rural local bodies accounts are on cash basis in most states. They are on a software called PriyaSoft. Many of you might have come across this during your accounting or audit engagements. There is also a scope to relook at the standards and how they relook at these accounts and see how they can be aligned to the cash basis IPSAS. Of course, urban local bodies are on accrual accounting, so I'm not even bringing them to the picture here, or at least they are supposed to be on accrual accounting. So where the National Municipal Accounts Manual and accounting standards for local bodies of the CA Institute can come into picture. But PRIs and state and union governments, yes, definitely it could be done. A very good opportunity has opened up with the 15th Finance Commission talking about harmonization of accounts at different levels of government. They are saying each entity, each level of government is preparing accounts in its own format. So at some level, at least there should be a harmonization. If not at the chart of accounts level, at least at a higher reporting level, it has to be harmonized, which is a huge challenge. Of course, between the union and state, there is some scope for harmonization. But when it comes to the local bodies, the formats are different. Urban local bodies, the basis of accounting itself is different. They are on accrual, state is on cash basis. And there are so many inter-transactions between levels of government. All those have to be eliminated. But given that the Finance Commission has spoken about it, and at some point it will be on the government's agenda, as we are doing it, it will be good if it could be done in line with the cash basis itself. Next is there are a whole set of entities outside of the core budget, the parastatal agencies, boards, development authorities, the regulatory corporations, the development corporations, which are continuing on cash basis accounting. So there is a scope for implementing the standard in the transition to accrual. In fact, there is a study conducted by GSAP long back. It is in 2008. Let me try to just open it up and show you. So this study, a study on gap analysis of Indian government accounting with international standards. Although it says international standards, primarily the gap analysis has been with the cash basis IPSAS. It's a very informative study. If you just look at the table of contents, it is pretty clear what all it covers. But the issue is that this was done in 2008. This report came in 2008, which was 15 years back. So there is a good scope for updating this publication, conducting a similar study. A lot of improvements have happened in the accounting formats of union, states, as well as PRIs subsequently. So now I'm sure we'll be more in line with the cash basis standard, if not exactly the way it is required. So there is a chance for updating this and then laying out a roadmap on how to move to cash-based IPSAS. So I'll not go into details of this, but pretty much it is covering requirement by requirement. It is talking of what is required to be done. I think lower down the thing. Yeah, there was also a World Bank tool, I believe, through which a diagnostic was conducted and to what extent it is complying with the cash basis itself. So there's a good opportunity. The fact that India has already done this itself is a very encouraging factor, and it's time to probably revive the agenda again. Then of course ICAI, which is already playing its part. and is the leading think tank when it comes to accrual accounting and transition to accrual. ICAI as well as the members can advocate usage of cash basis IPSAS whenever we engage with government clients on various engagements. The best part is that it might not require a change in the governing legislation. Accrual accounting will require a change in legislation, but here it is a change in disclosure and presentation only. So this could go below the radar, and interested entities can decide to present their financial statements in line with cash basis IPSAS. Of course, if a standard is introduced, then there is a legislative work involved. But even otherwise, it is possible to implement this standard. So just a quick thing on what is happening in other countries. As I was telling you, in terms of development in public finance, India has moved ahead on many counts, but on many counts, we are actually behind our much smaller neighbors when it comes to IPSAS adoption or climate budgeting or SDG budgeting. Though some things are happening, it's not that India is not doing anything, but other countries have moved forward. For example, if you see Nepal already has public sector accounting standards under cash basis of accounting, and it is aligned to the IPSAS. So it is largely in line with the IPSAS, but I'm sure there are some carve-outs because of which it is called Nepal Public Sector Accounting Standards and not directly IPSAS. A lot of this work is actually ready from the CA Institute side. Local bodies accounting standards are there. So it's a question of working towards notifying these standards and implementing them. Same, they're following the same thing, part 1 mandatory, part 2 not mandatory, encouraged. So pretty similar structure they're following. You can see the table of contents. Next is, of course, Pakistan also has done some work. So if you look at the government of Sindh, we were actually able to pull out the financial statements prepared implementing this cash-based IPSAS. For example, if you look at it, statement of cash receipts and payments, statement of cash flows. Then there is a statement of comparison of budget and actual amounts by function and again by department as well. So you can see two different ways of presenting the same information, and of course notes to financial statements. So there's a preface. Let me go to the statement directly, and the auditor is also certifying it. So if you look at the format, so you can see all the information is available here for the current year as well as the previous information. Receipts controlled by the government as well as by third parties separately shown. This is now actually an encouraged disclosure, but it's already been shown. This is of course 2014 statement. This is what was available on the public domain. At that time, it was a mandatory disclosure, the payments by third parties. So that is why it is shown here. Even though it was a bit dated, it was very good. So I thought we should just have a look at it. Similarly, statement of cash flows. They are even preparing it by operating, investing, and financing activities. Because I think the transition to accrual had already started. And IPSAS Part 2 says if you are doing the accrual implementation, then you might as well present the cash flow statement by this format, which is operating, investing, and financing activities. Similarly, comparison of budget and actual amounts. This is also being done. The original budget, the revised budget, as well as the actual for both the financial periods. And you can even see the classification basis, all of this is available, which is very consistent and very neatly presented as well. And it's not a very long statement, it's just a 20-page report. And again, all the disclosures, the reporting entity, statement of compliance, the basis of consolidation, where it is relevant, accounting convention, basis of preparation, reporting in budget period, the currency, significant accounting policies. So considering that it was done way back in 2014, this is a very good initiative, I would say. and all the key aspects of the standard are covered here. So basically these were it. In fact, there are a few more, some relating to Maldives, Sierra Leone, Liberia, and Jordan. But I felt Nepal and Pakistan being the closest neighbor and very comparable scenario, not in terms of size, of course, but in terms of the socio-economic environment, the demographics, and all that, and also the development challenges. So these two are good templates to go with. So this is broadly, I think, what I had to present, so that we have enough time for questions as well. And I mean, there is always chance to discuss more. The institute, the committee is quite active. You can approach them. You can approach me directly if any of you come across these cases and we need to discuss something on the implementation side. So I'll stop my screen share here and hand it off back to PA Anand, so that we can discuss any of the questions that have come up, plus any of his own questions.
Thank you, sir, for the wonderful deliberation. As you have told that 70% of the government accounts are not on accrual system yet, and government is targeting for 50% transition by 2025. You have spoken about the mandatory part, the other part as well. So what are the challenges? A very well quick insight on how we can move on to this IPSAS. So let's take the questions which we have received. So the first question is cash basis of accounting the norm in all the local self-government is in our nation prevails like?
Sorry, so what is the question?
Is cash basis of accounting the norm in all the local self-government in our nation?
No. In our country, in India, urban local bodies are on accrual accounting. They are supposed to be on accrual accounting, but we know that in many of the states, the migration from cash to accrual is still happening, and in many cases it is not yet complete. Whereas rural local bodies, the Panchayat Raj institutions, the block panchayat, the gram panchayat, and the district panchayat, Jilla panchayat, are mostly on cash basis accounting only. They have a system of accounting prescribed by the C&AG, which they are following. For urban local bodies, it is prescribed by the National Municipal Accounts Manual. One important thing to mention here is that there is a study recently conducted by the ICAI Accounting Research Foundation along with the NITI Aayog, which has looked at how accrual accounting has been implemented in 8 different states in India. What are the models they have adopted and what are the learnings from those models, plus other states who are going to do it now, how they can go about implementing. Some very good recommendations have come up from there. Myself and my colleagues were also fortunate to be a part of the study, but this is a study by ARF. It is available on the institute website. I think it should also be on the committee website as well, or on the website of NITI Aayog. So this could be useful too, if you want to learn more about this.
Right, sir. As you said that there is an accrual system which the local municipal body should adopt. So are you aware of any local government where in our country which has adopted this accrual system of accounting? Like any local municipal corporation is doing that? Yes.
Some are actually quite ahead in this curve of implementing. Again, going back to the study, drawing from the study, which was basically trying to answer the question that you just raised. Tamil Nadu, Kerala, and Karnataka. Definitely all the 3 southern states have implemented, and there is no old system running now. It is the accrual system only. Having said that, whether those are complete, whether they are giving 100% information, I would say yes, there are some issues there which the governments are trying to solve. Our members of our institute are also involved in auditing these financial statements. Other states have also done it. Maharashtra has tried it. Gujarat tried it. They did the second round. Bihar is trying to do it. But there and all, I would say the journey is still in progress. In terms of advancement, maybe these 3 states, having started earlier, they present it. The bigger corporations, many of them present very good financial statements. For example, if you look at Chennai Municipal Corporation or Mumbai Municipal Corporation, or many corporations in Gujarat, Baroda, Vadodara Municipal Corporation, you can see. Indore also has good financial statements. There is also, I think, the ICAI organizes awards for financial reporting. Of course, many had not applied, but some of the financial statements presented by Vadodara or Indore can be compared with any good corporate annual report, if you see, for that matter, in terms of richness of the information and the consistency of presentation and all that. They are very good. And it is also a requirement for raising municipal bonds that you should be producing financial statements under the accrual system of accounting. So that is also one of the reasons many larger corporations are proactively moving towards it.
Right, sir. You have rightly mentioned Indore is doing really well. Recently, they have launched a 250 crore bond public issue as well. Sir, moving forward, like the another question we have, as ICAI has published any accounting standard on the accounting of local self-government, and if ICAI has published such accounting standard, are they mandatory to follow?
ICAI has published, as I told you in the presentation, entire set of accounting standards called Accounting Standards for Local Bodies, in short ASLBs. These are applicable to urban local bodies as well as rural local bodies. It went through many years of painful exercise where each IPSAS was taken and then customized to Indian requirements. ICAI has brought it out as well as recommended to the state government, but they are not mandatory as such for now. But it's only a question of time before the GSAP and the CAG make it mandatory. And the final call is with the Ministry of Housing and Urban Affairs. So they will have to notify this standard. And the next upgrade of the National Municipal Accounts Manual, I'm sure, will incorporate a heavy element of the standards issued by ICAI. And they're available on the committee website as well, institute website. So you can have a look at those.
Right, sir. So we can see that there are a lot of professional opportunities for us in coming future in this field of government accounting, public finance.
Absolutely. Agree.
So, sir, the next question is, nowadays many local bodies are receiving foreign currency grants as well. So, what is the rate of converting? How we can convert these grants into the books?
Okay. This is, of course, a technical question, but very briefly, if I were to say, what the standards require, the cash basis standard is that on the day of the transaction, whatever exchange rate prevails, you convert the foreign currency to local currency at that rate and report it at that rate. And closing cash balances, if you have in foreign currency, you apply the rate at the date of the last day of the financial year or the day of preparation of financial statements, I would say. Because if you are preparing interim financial statements, you would apply the date on which you are preparing. And any exchange, any differences, gain or loss arising out of this has to be recognized in your income and expenditure statement. Broadly, this is how it would be reported. But directly local bodies getting foreign exchange grants, maybe there might be one or two cases, but it is actually not very prevalent. It normally gets routed to the union government or state government. If there are cases, it will be interesting to understand that.
Right, sir. Sir, there is another question that what could be the examples of related party disclosures in case of this municipal corporation and local bodies?
Okay. For example, if you look at our typical municipal body, it consists of elected people who are councillors. It also has officials who are involved. So any entities to do with any of these councillors or officials, as a first case, would directly qualify as related parties. There is a whole standard around it. Suppose you float a tender, then a company which is related to a councillor actually gets the tender through a transparent process. You have awarded the tender. Then it calls for a disclosure where you would say that there is a tender of this much amount is being executed, a contract of this much amount is being executed by entity so and so, who is related to the one of the councillors of the municipality. So these kind of disclosures are quite possible.
So we have to check such disclosures and paper formalities to identify what are the related party transactions in this case.
Yes, correct. It's a challenging thing to implement, but that is what the standard requires.
Right. So, sir, there is another question that how much time it takes generally to move from the like case system of accounting to accrual system of accounting in this IPSAS and the whole level of government.
Okay, I need to take it in two parts. One is transition from cash system to accrual system. It purely depends on the size of the entity and the complexities. But let us take, for example, a case of a medium-sized municipality, maybe a Pune or Indore, actually which are larger, but they're not as big as a Mumbai or a Chennai kind of municipality. So again, going back to the study I was mentioning, ICA NEP study, we have actually tried to give a roadmap of how long it will take and what we need to do in each stage, along with the checklist also. So our estimate was that 18 months is a reasonable period. In the first 6 months, you would be doing the requirement study, getting the software in place, amending your laws and all that. Of course, amending laws takes a little more longer than 6 months. But implementation gets complete only when you are able to generate the first year's financial statements under the accrual system. Otherwise, everybody might say we have implemented, but unless the balance sheet comes out in the new system, you are never sure, and you can always expect something or the other, some troubleshooting required. So the first year financial statement, when you are able to bring out, then you can say implementation is reasonably complete. From the decision to be able to see first year statements, 18 months should be a reasonable time. But the second part of the question of transition to IPSAS, that question is still open because at least in India we have not tried it yet, and some of these IPSAS are actually very complex. For a Indian scenario where we are still on cash basis accounting, I need not even mention all of you might have experienced the Ind AS implementation. So we know there are a lot of valuation, measurement, recognition challenges which need to be taken up. In case of government, you can even multiply it by twice or thrice. The challenges will be that much more. So it has to be a journey, and I think at least 2 years financial statements have to come out before we can say we have a transition.
Right, sir. So whether this cash basis of IPSAS mandatory, any format for income, expenditure account and balance sheet, like any standard format is there?
Actually, there is no standard format because, as you know, standards do not prescribe the standard format. Even if you take commercial accounting, the balance sheet format is not there in any standard. It is principle based on recognition, presentation, recognition, valuation, measurement, as well as disclosure. So in India, it is not yet mandatory because, as I told you, some action happened way back in 2008. But after that, there is no cash basis standard that is mandatory in India.
Right, sir. So as we knew that our members and some of the government people are also have joined this webinar. So how government should plan to move from cash basis IPSAS and then accrual basis IPSAS? Suggest can you suggest some way forward for this?
The cash basis IPSAS is actually not very difficult for government to move into, because most governments anyway prepare the receipts and payment statement as part of their annual account. Budget variance anyway is a very important tool within government to monitor. Explanatory notes are there in some form or the other. And the format of accounts prescribed by the C&AG has, I don't remember how many statements, which cover different aspects of what is required by cash basis IPSAS. So what is required to do is conduct a study, first map the requirements of cash basis IPSAS to the current statement of accounting, which can be a very good initiative by the maybe C&AG and ICA together, or ICA could do on its own and prescribe to the government saying this is what needs to be done. After that, it is notification by GASAB and TGA, and then it gets implemented. So that is not very difficult. I believe a 1 year time frame should be much easier. Accrual accounting transaction, easily, according to me, would be a 5 or 10 year exercise for the government. I mean, I'm just giving out a number, but considering the complexities of accounting in government, I'm talking of all three levels of government. Local bodies, obviously, it is much easier, but when you come to state government and central government, some of our colleagues might have been involved in the accrual transition exercise that happened in railways. So we know it was a massive exercise where the ICAI ARF was deeply involved, and I'm sure it would have taken 3 to 5 years to get to that stage. So in government, yes, it has to be a roadmap of maybe 5 to 10 years, where progressively you include more and more complex elements of financial reporting. It cannot be a one-time switch from cash flow accrual. Of course, that's just an estimate to reply to your question now, but a proper study and roadmap will be very useful in this direction.
Right, sir. So as you have mentioned that all the three levels are different. So whether the government of India prepares the consolidated financial statements, like including all these local, state, and central accounts?
No, in India there is no consolidated reporting at all, either at union government level or state government or local body level. Because one is the complexities are many. Second is it has not been attempted earlier, and at least union and state, okay, they follow the same kind of chart of account. But when it comes to local bodies, the chart of accounts and the basis of accounting is also different. But can be done. And 15th Finance Commission has raised this point also, that there is a need to, if not consolidate, at least harmonize, so that the reporting formats are same and you can compare. And it need not be at a chart of account line level consolidation. It could be at a much higher level consolidation by functions of government you can consolidate, or by ministries and departments. So that level is definitely achievable.
Thank you, sir. As our questions are now over, so I thank on behalf of the committee and the institute to you for sparing your precious time for this conclave. And moving forward, I request Shivani ji to please take over.
Thank you.
Thank you very much, sir, for the wonderful session and answering the queries of the participants. Thank you so much, sir.
Okay, thanks. It's been my pleasure.
Thank you all the viewers for joining.